Hello everyone and welcome to Fun with Fitzy. This is Chapter 2, Video 2, and we're going to be talking about the journal and journalizing. As you know, one of the steps of the accounting cycle is to record. And what that means is to actually record the transactions. And before we put the transactions into the T account or the ledger, we need to record it in the journal, which is also known as the Book of Original Entry. So the first thing we need to do is analyze each transaction, which requires us to think about what accounts are affected and if they're going up or down. Then you're going to enter that transaction into the journal. And then you transfer that journal information to the ledger. The act of doing this, moving it from the journal to the ledger, is called posting. So here's an example of journal paper. We've all seen this before. There's room for the page number here, and if you recall, the page number is always going to be page 1 when the company is just starting. However, if the company has already been in existence, we're going to use page 2. We're going to use this date here, and we're going to put the year, the month, and the day of the month. We're going to put our debits and credits in the particulars column, and we're going to put the amounts that we debit and credited here. And the posting reference is when you post it, it's the number of the ledger. You're going to put it there. So generally speaking, the posting reference column is blank until you post. Transactions are initially recorded in chronological order. That means in order that they occur, in order of time, in a journal before being transferred to the ledger, which is a book of accounts. We just talked about that. And every company has a general journal, which contains the spaces for dates that we just talked about, the particulars column where we're going to put the account titles and our explanations, the posting reference column, and the two money columns of debit and credit. We just talked about that. The journal makes several significant contributions to the recording process because in one place it discloses, that means it shows, the complete effect of a transaction. Whereas if we just use the T accounts, you would have to go looking from one page to another just to see one transaction. And it also provides a chronological record of transactions. That means like a journal, like your diary, you keep track of things that happen. Well, here is a journal or a diary of all the business transactions. Also, it helps to prevent or locate errors because debit and credit amounts for each entry can be compared right away, right beside each other. If your debits don't equal your credits, then you've done something wrong. Journalizing is the act of entering the transaction data in the journal. So when I say journalize it, that means I want you to put a transaction in the journal. Separate journal entries are made for each transaction. You're going to leave a space between each of them. And therefore, once you're done, a complete entry consists of the date, the two accounts or more. If you only have one, you've done something wrong, and the amounts to be debited and credited, and a brief explanation of the transaction. Then you're going to leave a line, leave a space, and do it again for the next one. So let's take a look. The date of the transaction is entered there. Always put the year and the month and the day. When the month is the same and the year is the same, you don't repeat it. You do change, however, when the month changes, you would put October there. The debit account title is entered at the extreme left, so not indenting it. And the credit account is indented. So here's one example of the credit being indented. Here's another example of the credit being indented. You should be able to put a finger space there. And again, your debits are right against the margin. The amounts for the debits are recorded in the debit column, and the credits are recorded in the credit column. Okay, so we can clearly see that in the first transaction, the owner invested cash. Cash is going up because you're debiting it, and when you debit an asset, it goes up. And you can see the credit of $15,000 here is going on the credit side, and that therefore this account is going up because owner's equity accounts go up on the credit side. Then finally, you put an explanation. In grade 11, we put our explanations right at the margin, which is fine. Either way, it's up to you. I prefer them at the margin, but this textbook puts them further indented. Then here's the space I'm talking about. Always leave a space between your journal entries. And as I mentioned earlier, the column here, the reference column, sometimes it says PR, is left blank at the time the journal entry is made and is used later when the journal entries are transferred to the ledger. If an entry involves only two accounts, a debit and a credit, it's a simple journal entry. However, if it involves more than two, here you can see there's three. There's delivery equipment, cash, and notes payable. Then that's a compound journal entry. Most of our transactions will be compound journal entries because of HST. Now, just to point out, when we are journalizing, as I mentioned, your debits go first and right against the left margin. In this particular one, you have a credit, then you have a debit, and then you have a credit. And I can tell here that it goes credit, debit, credit. And I also can tell it goes credit, debit, credit here because they're indented. Remember, we indent our credits. Always put your debits first. Okay, so by now you should be able to explain what the general journal is, understand and demonstrate how to record a business transaction in the journal. And thanks for watching.